Building your portfolio on an S&P 500 fund is a fantastic foundation for wealth. But what if it's just step one? What if there's a way to upgrade that solid strategy, making it even more resilient for the decades to come? Let's explore the difference between a good portfolio and a truly bulletproof one. The S&P 500 is the default starting point for millions, but building a truly powerful portfolio requires more than just one fund. It requires a strategic blueprint. In this video, we are going to move beyond the basics and architect a 5 ETF portfolio designed for superior long-term performance. We will conduct a data-driven analysis of each component, from its core strategy and top holdings to its risk profile. By the end, you will see exactly how to combine these funds into 3 distinct portfolios tailored for different life stages, built to give you a strategic edge. Our first component is the engine of the portfolio, the bedrock of American capitalism, the Vanguard S&P 500 ETF, or VOO. Think of this as raw horsepower. Its job is simple: to give you a direct ownership stake in 500 of the largest and most influential companies in the United States. When you buy VOO, you are buying a piece of the titans that define the modern economy. It's a bet on the continued innovation and profitability of corporate America. Its primary strength is its potent combination of performance and low cost. With an expense ratio of just 0.03%, it's incredibly cheap to own. The fund's performance is reflected in its impressive 10-year compound annual growth rate of 13.60%. To put that in perspective, a hypothetical $100,000 investment a decade ago would have grown to over $357,000 today. However, this engine has a critical weakness. Its diversification is an illusion. The fund is heavily concentrated in a few giant technology stocks. Its top sector is information technology, making up over 30% of the fund, followed by financials at 13% and healthcare at 10%. This concentration is reflected in its top 10 holdings, where you'll find NVIDIA, Apple, and Microsoft, making up 34% of the fund's value. This means an investment in VOO is a massive, concentrated bet on the continued dominance of a handful of companies. This concentration is what fueled its incredible returns, but it's also its greatest risk. It's all gas, no brakes. In the 2020 market crash, VOO plunged 34.7% from its peak. It's a fantastic core holding, but it's a volatile one that needs to be balanced. If VOO is the engine, our second component, the Schwab U.S. Dividend Equity ETF, or SCHD, is the advanced braking system and suspension. Its job is not to be the fastest, but to be the most reliable and provide a smoother ride. It's designed to capture the quality factor, another academically recognized driver of long-term returns. SCHD doesn't just buy big companies. Its underlying index acts like a strict financial auditor. To even be considered, a company needs an uninterrupted 10-year history of paying dividends. After that, it's screened for fundamental health, strong cash flow, low debt, and high return on equity. This filters for about 100 of the most durable blue-chip companies in America. Its sector allocation is far more balanced than VOO's, with its largest sectors being consumer defensive at 19%, energy at 18%, and healthcare at 14%. This defensive posture is clear in its top holdings, which include companies like Coca-Cola, Verizon, and Cisco Systems. SCHD is also top-heavy, with the top 10 holdings making up over 40% of the fund. Now let's be clear about its role in a crash. During the sharp 2020 downturn, SCHD fell right alongside the broader market. Its defensiveness isn't about magic immunity to crashes. Its true strength is psychological and financial. When your portfolio value is plummeting, VOO gives you nothing but a lower account balance. SCHD, on the other hand, keeps depositing cash into your account. This regular dividend income is a powerful psychological anchor. It's a tangible return that reminds you that you own real, profitable businesses. This cash flow gives you the fortitude to stay the course and avoid panic selling at the worst possible time. It also provides dry powder, cash you can use to reinvest and buy more shares at bargain prices. The trade-off for this stability is slightly lower, but still excellent long-term growth. Its 10-year compound annual growth rate of 11.18% provides the mental and financial strength to survive the journey. Also, its expense ratio is at the low end at 0.06%, which also helps with capital preservation. Now we move to our satellite holdings, the offensive weapons. First up is the Vanguard Small Cap Value ETF, or VBR. Think of this as your underdog hunter. For decades, academic research has shown that smaller, undervalued companies have, over long periods, delivered higher returns than their large-cap counterparts. This phenomenon is known as the small cap value premium. VBR is designed to capture exactly that. It invests in over 800 smaller U.S. companies that are trading at a discount, primarily in the financials at 20%, industrials at 19%, and consumer discretionary at 13%. These are the regional banks, industrial manufacturers, and specialty retailers that form the backbone of the economy. This is precisely why it has the potential to beat the S&P 500. It taps into a source of excess returns that VOO completely ignores. Furthermore, it's highly diversified at the individual stock level. Unlike VOO, VBR's top 10 holdings make up just under 6% of the fund. You aren't reliant on the fortunes of a few giants. Its expense ratio is at the low end at 0.07%. But this potential for higher returns comes at a steep price: extreme volatility and brutal cyclicality. The value premium can disappear for years at a time, causing funds like VBR to underperform. Its 10-year return was a modest 8.39%, but its 5-year return was a much stronger 15.17%, showing how its performance comes in waves. And the ride can be gut-wrenching. During the 2020 crash, VBR lost a staggering 45% of its value. This is a high-octane weapon, not a core holding, and it requires the discipline to hold on through years of potential underperformance to reap the rewards. Our next satellite holding is the Vanguard FTSE Developed Markets ETF, or VEA. This is the global competitor. Putting 100% of your investment portfolio in the US is a massive, unforced error. It's a bet that one country will outperform all others, forever. A bet that has been wrong for entire decades in the past. VEA provides you with ownership in over 4,000 companies across the other major developed economies of the world. Its geographical allocation is well diversified, with its top countries being Japan at 21%, the United Kingdom at 12%, Canada at 10%, and France at 8%. Its sector bets are also different from the US, focusing on financials at 23%, industrials at 18%, and healthcare at 10%. This means you own global giants that are underrepresented in a US-only portfolio, like the Danish pharmaceutical company Novo Nordisk, the Dutch semiconductor equipment maker ASML Holding, and the Swiss food conglomerate Nestlé. Fund's expense ratio is rock-bottom 0.03%. So why could it beat the S&P 500 going forward? The simple answer is valuations. After a decade of historic outperformance, U.S. stocks are expensive relative to their international peers. If history is any guide, these valuation gaps tend to close over time through a process called mean reversion. The risk, however, is clear from its 10-year compound annual growth rate of just 6.82%. It has lagged the U.S. significantly. VEA is a long-term, strategic allocation based on the proven principle of global diversification. Our final offensive weapon is the most specialized, the Columbia EM Core ex-China ETF, or XCEM. This is your targeted growth missile. It's designed to give you exposure to the fastest-growing economies in the world, but with a strategic twist. XCEM invests in emerging markets, but as its name suggests, it completely excludes China. This allows an investor to avoid the specific geopolitical and regulatory risks associated with that single country. What you are left with is a portfolio that is heavily concentrated in a few key regions. Its geographical allocation is a targeted bet, with India at 27%, Taiwan at 26%, and South Korea at 14%, making up over 2/3 of the fund. Its sector allocation is dominated by information technology at 30%, followed by financials at 27%. This concentration is clear in its top holdings. The world's most important chipmaker, Taiwan Semiconductor, TSMC, is a massive 13% of the fund on its own, followed by the South Korean tech giant Samsung Electronics and the Indian conglomerate Reliance Industries. This is why it has the potential to beat the S&P 500. It's a concentrated, high-conviction bet on the future of the global technology supply chain and the rise of consumer economies in places like India. The risk is a mirror image of its strength: extreme concentration. Its fate is heavily tied to the highly cyclical semiconductor industry and the complex geopolitics of one specific island. With a 5-year compound annual growth rate of 10.85%, it has shown its growth potential, but it must be handled with care as a small tactical allocation. Another drawback is the higher expense ratio at 0.16%. We have our 5 elite ingredients. Now let's combine them into 3 distinct portfolio recipes tailored to your stage in life. But first, why does this combination have the potential to beat the market? A simple S&P 500 fund is a one-trick pony. It only gives you exposure to one factor: US market beta. This 5 ETF portfolio is a multi-asset Swiss Army knife. It is strategically built to capture returns from 4 distinct and academically backed market factors: US market beta through VOO, dividend quality through SCHD, the small cap value premium through VBR, and international exposure through VEA and XCEM. Since these factors often perform well in different economic environments, for example, value may outperform when growth is struggling, combining them creates a more resilient portfolio that has more ways to win over the long term. Here are the blueprints. First, for the young accumulator, those in their 20s to 30s who has a long time horizon and can maximize risk for growth: 40% VOO, core engine; 25% VEA, global competitor; 20% VBR, underdog hunter; 15% XCEM, growth missile. This is an aggressive portfolio where the 30-plus year time horizon allows the investor to withstand the severe volatility of VBR and XCEM to capture their potential outperformance through the power of compounding. Next, for the balanced grower, those in their 40s to 50s who needs to balance continued growth with wealth preservation as retirement gets closer: 40% VOO, core engine; 25% SCHD, defensive anchor; 20% VA, global competitor; 10% VBR, underdog hunter; 5% XCEM, growth missile. Here, we significantly increase the defensive anchor SCHD and reduce the highest risk satellites. The goal is to still capture growth from all factors, but to reduce the portfolio's overall volatility and protect the capital that has already been accumulated from a major drawdown. Finally, for the capital preserver, those in their 60s and beyond, where the primary goal is stability, income, and mitigating sequence of return risk: 60% SCHD, dividend anchor; 20% VOO, core engine; 15% VEA, global competitor; 5% VBR, underdog hunter. This allocation is heavily tilted toward defense. We boost SCHD to its largest allocation to maximize income and resilience while removing the most volatile component entirely. This is crucial for retirees, as a large loss early in retirement can permanently impair a portfolio's longevity. So what's your verdict? Are you building the aggressive young accumulator portfolio or the defensive capital preserver? Let me know in the comments. And if you want more data-driven guides to build a smarter portfolio, subscribe now and click the video on the screen.